All right, welcome back to Last Call. Now let's talk about your money because we're CNBC, right? It was also another good day for stocks as we head into the Thanksgiving holiday. Green across the screen on the major averages. Dow, S&P, and NASDAQ up about 1%. We're now about 1% away from their 2023 highs. All this, as we just talked about at the top of the show, crude oil falling, hitting a 4-month low, following the OPEC news. In the meantime, or maybe because of, the 10-year yield went down as well. Both oil and the yield bounced back. Look at that. Oil and the 10-year yield go together, and I'm telling you, oil looks like it's leading the 10-year yield, which could matter for stocks, which means maybe oil is actually determining which way stocks go. Or I just completely made that up. Which brings up an important question. Will falling oil prices and interest rates continue to fuel this year-end rally, or do their declines maybe signal a slowing economy and maybe trouble for your money? Let's talk about it with our markets panel on set. StoneX Chief Market Strategist Kathryn Rooney Vera and Veritas Financial Managing Partner Greg Branch. Usually you're both in Miami. You've been trying to get coffee with each other. Just that, we're both in Miami and on CNBC. Couldn't do it there, but somehow you're doing it here. Yeah. That's what we do.
That's amazing.
We bring people together. So sometimes we rip them apart, but usually tonight we're going to bring them together. Kathryn, is oil that important to the stock market, or is that just kind of a random chart correlation that means nothing?
No, it's important. It's important for equities. I think it's one of the three important inputs that have caused margin pressure on corporations as oil prices go up, labor costs go up, real rates go up. That has caused pressure on margins. So the fact that oil is going down, great, because it's an input. So that's important. The problem, however, is if oil's going down because we're going into recession, it's kind of like the Treasury yields. If yields are going down, but we're going into recession, that's not good for
but do you
stocks.
think Kathryn, you would agree that bond yields matter for the equity markets, right?
They absolutely do.
So when I look at that chart, and this is 3 months, so whatever, not that one, the one that correlates the two guys, thank you. And you can go back a year, 3 years, go on CNBC.com, do a custom chart, whatever. Oil and the 10-year yield look like they track each other. So I'm not trying to overstate the industry I cover, or maybe I am, who knows. But it looks like that could determine where stock prices go next year. I don't know.
They generally do have a positive correlation unless you're on the precipice of recession. I'm not saying we are, but that's the historical correlation. Bond yields go up, Treasury yields go up, because there's that cyclical component and they both follow the economic cycle. So if we're going into recession, then oil prices go down, fixed income outperforms. Yields go down, prices go up. So yes, equity risk premium has been atrocious in the United States and in Europe. Why? Because the 10-year yield is so remarkably high, rendering equities less appealing to the investor. So the same could be said for oil. If it's predicting, or if we're on the cusp of a slowdown in demand, which effectively we are already seeing from Chinese demand, then I think there is headwinds to the U.S. consumer going into next year.
That is incredibly well anchored. It's the Wednesday before Thanksgiving.
Fantastically well anchored.
Yes, let's have some fun, right? So what's the outlook then? What can we expect? Let's start talking about 2024, Kathryn.
I like fixed income. It's boring. It's not sexy.
It's super
but hey, you know
boring
what?
is the new sexy, apparently. But what kind of fixed income? It's a big market.
Look, I think treasuries, when they hit 5%, that was a buy, the 10-year. I still like near-term treasuries. Greg nailed it. Inflation expectations are moving higher. Initial jobless came in better than expected, which means that's not good for the Fed because it shows a robust labor market. Okay. That, to me, says that that we need to be looking for duration in the fixed income space. I think in this 4Q of this year, it makes sense. I think in the equity space, you want to be defensively positioned in late cycle sectors.
Greg and Kathryn, great to see you on set. Glad that we could bring you guys together in New Jersey. So safe travels and a great Thanksgiving. Appreciate it.